You know, we're surrounded by connections. From financial markets to weather patterns, everything seems to affect everything else. But how do we actually model those connections? Especially when the things we're trying to connect are, well, fundamentally different? Today, we're diving into a really powerful statistical tool that's designed for exactly that challenge, the copula.
It really all boils down to this one big question. How do you build a mathematical bridge between two worlds that just behave in completely different ways? How do you model their relationship, particularly when things get wild and chaotic at the extremes?
So, let's take a classic example from finance to make this real. Stock returns. They can be super volatile, right? Big swings up, big swings down. But then you have bond yields, which might be much more stable. They're like two different worlds, each with its own unique behavior. The absolute crucial question for any investor is, how do you model their combined risk? What's the chance they both crash at the exact same time?
And that right there is what we call the dependence dilemma. It's this core challenge of trying to describe how different variables move together. I mean, it's one thing to see if they generally move in the same direction, but the real test, the thing that really matters, is modeling what happens during those extreme events, because that's where all the biggest risks are hiding.
Now, you might think the first step is to just jump right in and start connecting things. But actually, the first step is kind of the opposite. To understand how things connect, we first have to perfectly understand them all by themselves, in isolation. We need to know the unique character of each variable before we can even think about how they interact.
All right, so how do we actually do that? How do we describe the unique character of a variable? Well, in statistics, we use something called a probability distribution. Let's take a look at what those are all about.
Honestly, the best way to think about a distribution is like a personality profile for your data. It tells you absolutely everything about a variable, what values it's likely to have, how spread out it is, and whether those crazy extreme values are common or super rare. It's its complete biography.
So check this out. Here's one of those personalities in action, the exponential distribution. If you look at its shape on the left, you can see it's often used to model things like waiting times, say for a taxi. Most of your waits are going to be short. See that big peak at the beginning? But that long tail stretching out to the right, that represents the small but real chance of a very, very long wait.
Okay, so we've got our stock returns with one personality, our bond yields with another, and you can imagine countless other variables, each with its own unique distribution, its own unique language. So here's the problem. How do we get them to talk to each other? How can you possibly compare an exponential personality to, say, a normal bell curve personality? They're totally different.
Well, it turns out there is a solution. It's a kind of statistical universal translator, a method that can take any of these unique individual personalities and convert them all into a single, common language that they can all understand.
This translator is called the probability integral transformation, or PIT for short, and its key insight, honestly, it feels like a magic trick. It says that if you take any continuous variable, doesn't matter what it is, and you run it through its own specific cumulative distribution function, its CDF, the result is always the same. You always get a uniform random variable that's somewhere between 0 and 1.
Okay, let's break that down step by step. First, you start with your variable. Let's say it's our taxi waiting time. Second, you apply its own specific exponential CDF to it. And third, boom, out comes a number between 0 and 1. And the amazing part is, if you did this for stock returns, which have a totally different distribution, you'd also get a number between 0 and 1. Suddenly, everyone is speaking the same language.
And this flowchart right here, it perfectly shows that journey. We start over on the right with all our unique variables, each with its own personality. We apply their CDFs and we transform them into this universal language of uniform distributions you see in the middle. They've all been standardized.
Okay, so now that all our variables are speaking the same uniform language, we can finally bring in the main event. This is where we introduce the tool that's actually going to connect them. This is the copula engine.
This equation. Yeah, I know it might look a little scary, but it's the absolute heart of everything. It's Sklar's theorem, and it's basically the blueprint for how all copulas work. It says that the joint distribution of two variables, that's the hxy part, can be built by a copula function, c, that takes their standardized versions as inputs.
And here is the absolute game changer, the most crucial point. The copula lets us pull apart a variable's individual personality, its marginal distribution, from its relationship with other variables, what we call the dependent structure. This is a massive breakthrough.
It means we can model each part independently and then join them together. So if we look back at our flowchart, we can see the whole picture now. The standardized variables from the right all feed into that copula in the center. The copula is the engine that processes their relationship, and it's what creates the final, combined, joint distribution over on the left.
But wait, it gets even cooler. Not all relationships are the same, right? So a copula isn't just a one-size-fits-all tool. You actually get to choose the flavor of dependence that best describes your data. It's like picking the right tool for the job. Okay, so look at these two. On the left, you've got your standard Gaussian copula. Pretty symmetrical, well-behaved. But now, look at the one on the right, the student's T copula. See how the corners are yanked up into these sharp peaks? That is tail dependence. It's a visual sign that there's a much higher chance that both variables will experience extreme highs or extreme lows at the exact same time. And for managing risk, that is everything.
And the flavors keep coming. You can get even more specific. The Clayton copula on the left, see that peak in the bottom left corner? That's all about modeling lower tail dependence, a really strong link during joint crashes. The Gumbel copula on the right is the complete opposite. It models upper tail dependence, or a strong link during joint booms. You get to choose the tool that actually fits the story your data is trying to tell you.
All right, I know this has been a lot of theory, so let's get our hands dirty. Let's make this super concrete. How does this actually work with real-world data? Let's go back to our financial example.
So here we are, a scatter plot of daily returns for the Dow Jones Industrial Average versus the 10-year Treasury bond yield. I mean, you can kind of see a mild positive relationship, but what's really happening at the edges, in the extremes? What kind of copula best describes this relationship?
And when we run the numbers, the results are crystal clear. The best fit is a student's T copula. And see that number there for degrees of freedom? That's the key. A really low value like that is a huge flashing signal that the relationship has much fatter tails than a normal distribution would ever suggest.
So what does that actually mean? It confirms that the relationship between these two assets has fat tails. In simple terms, it means that those wild, extreme movements, big market crashes, or huge spikes are much more likely to happen together than a basic model would ever tell you. The student's T copula captures this hidden risk perfectly. So let's just zoom out for a second and end with this idea. The real magic of the copula is its incredible ability to separate what a thing is from how it connects to everything else. Now just think about that for a moment. If you could do that for any system, what kinds of unbelievably complex problems could you finally start to solve?